So, hello everyone. Welcome to this exciting curtain raiser, where today we'll be talking about how the 2026 looks like for agriculture commodity. Let me just do a small audio check and video check. Neeraj, am I audible and visible?
Yes, sir.
Awesome. So, thanks a lot everyone to join me today. As I said, it's a curtain raiser. So, we'll be having a series of sessions starting from 5th of January all the way till 10th of January, where we'll be covering various agriculture commodities. And I thought, what better way to introduce this concept than to go live and talk about how the agriculture commodity basket overall would look like in 2026 and the decade later. And for doing that, let me share my screen and we'll go through the presentation. And I'll try to be as brief as possible. We would not be covering too much of jargons here because the idea is very simple that we don't want this to be, I would say, the suspense killer. So what we'll be discussing over next week from 5th to 10th, I just wanted to run through on a broader aspect of it, that how things looks going forward. And with that in mind, we'll take it forward and we'll talk about some of the, I would say, the fundamentals which are impacting the way we are handling our overall agriculture commodity. So, what to expect in agriculture commodities in 2026? That's what we'll be talking about today. And as I said, from 5th to 10th January 2026, HnyB and AGTRADE is organizing this commodity week. We are having some of the best speakers in the world, all the way from Canada, Latin America, Central Europe, Western Europe, Black Sea, India, Africa, Southeast Asia. So we have covered all those who would be taking, I would say, interesting discussions forward, because it is very important that actually, we are able to talk about something which is global in nature. And this is where I believe, the whole discussion would be. So let's talk about on 5th, maize, 6th, wheat, rice on 7th, soybean on 8th, chickpeas, where we'll be covering more, not just chickpeas, but also the overall pulses basket and its impact on different part of those baskets. So how yellow peas impact chickpeas, vice versa. And then on 10th of January, we'll be talking about sugar. So now let me talk to you about how do we see 2026. So 2026, I don't see it to be a one theme year for agri commodities. Different agri commodities, I am made to believe, based on my research, that would act differently. Because we are seeing, for example, in grains, right? We are having glut. We are having our grain silos filled with rice in India. We are having wheat silos filled in Black Sea, or for that matter, in South America and North America, we are having huge amount of maize available. While we go to pulses, the scenario is not same, right? We are seeing that there could be little bit of deficit production because of acreage loss in, for example, Pigeon pea or black mape in India. Similarly, we might see that there is glut when it comes to yellow peas and lentils in Canada, or even if we see that in Australia, we would be having a substantial amount of lentils and chickpeas. Similarly, in Russia, yellow peas. So we see that pulses basket is not just like grain basket, where actually there is just a glut. We are seeing challenges out there when it comes to pulses. Similar story is when it comes to the oil basket, veg oil basket, or the oil seeds. We are seeing that soybean, huge quantities, but at the same time, we are seeing that because of various factors I'll be talking about, palm production might see a dip. So even in oilseed, you'll find a little bit of volatility, and I would say that supply crunch. So this year would be, I would say, which would be signified by the small shocks, right? And these small shocks in some of the commodities can lead to big price movements. especially when we talk about vegetable oils, when we talk about pulses. Uh, at the same time, also in some of the grains, because it is just not about having sufficient production, it is also about getting that production to the end users. So we might say there could be shocks there as well. So 2026, I would say it is about volatility, volatility in geopolitics, volatility in currency. We have already seen that the USD versus INR or USD versus Baht or USD versus Euro, those calculations are going to be playing very important role. Then the trade routes, there are challenges there. We have seen that insurance has increased. In some of the corridors, we have also seen that the freight prices has gone up substantially. Second is the policy, because when you see volatility in availability of product, the governments become protective. So we might see the challenges there, where some of the governments might uh, put export bans, put import bans, and try to create buffers. So the policy volatility is also be there, and the policy buttons are going to be very important when you want to take a call on commodities. Third aspect, climate. While we have seen that already talks are in that this year towards second half can become an El Nino year, we are also seeing the heat stress, specifically during the period of maturing of wheat in northern hemisphere. In southern hemisphere, we are seeing that actually there are challenges of the rain, which are I would say transient rain rather than following the normal patterns. We are seeing suddenly the windows of heavy rain and then having the long period of or long dry periods, so that is going to also impact. So the climate problems are going to add up. Uh, and as I was talking about increase in price of logistic and insurance, they are pretty much driven by the geopolitics. We are already seeing what's happening in around Suez Canal, Gulf of Aden. We are already seeing that what's happening in South China Sea. We are also seeing what's happening close to Panama in typically like the Western Hemisphere, where we are seeing that various players have started taking military positions. So all of these are going to impact logistics as well. So it's just not about price; it's also about the availability because of logistics. Now let's make a mental frame of how the 2026 looks like. So as I said, climate risk, it is structural now. So unlike in past, when we used to talk about climate could be a transient event where we could see that there is a flooding or there could be dry spell. But as we see today, the things have changed substantially. Now we are seeing it is a structural change. Everybody in the world, except a couple of people, have already appreciated and agreed upon the climate change. And this is where we are seeing that the adverse, or I would say intense climatic activity over past 5 years are far more than past 2 centuries. Now that tells you that actually how the weather is playing. So whether it is typhoons, whether it is super floods of Western India and Eastern Pakistan, or whether we see the challenges coming from Indonesia, we are seeing across the globe that the climate pattern has become very variable. It is unlike in past when we have predicted it well. Now the prediction of agriculture of climate is very very limited, and still we have not reached there. We can give short-term predictions, but long-term prediction is totally, I would say that not possible. Then the trade corridors remain fragile. As I was telling you, like I'll take an example of like in what's happening in Gulf of Aden. We are already seeing multiple wars there. We have seen Israel versus Iran. We have already seen Saudi Arabia versus Yemen. And similarly, we have seen that first time the war has gone beyond the strait. We have seen missiles flying all the way from Iran to Qatar. So those type of things put substantial pressures on shipping line and the trade routes. Similarly, we are seeing that what US is doing in Venezuela, they've already gotten off and created a blockade, and that place is pretty close to Panama Canal. So there also we are seeing a disruption of trade routes. Black Sea routes have already been under pressure for past at least 3 years and Russia war has started. And now, last but not the least, what is happening in South China Sea? Now, South China, we are already seeing that China is taking posture uh, against Taiwan, and that has also disrupted substantially the trade corridors close to Malacca Street. So all these key corridors are choke points, and any, I would say, increase in political volatility can create further challenges. And I see there is a possibility, at least in one of these places, it can go out of hand. Then I was talking about earlier the policy. So I will give you example. For example, in India, we are in a situation where pulses are very important, but at the same time, pulses leads to, uh, I would say, livelihood for the farmers, and the government is having policy of having a minimum support price for the farmer. So whenever they see that the prices in the market has gone down substantially low, they would try in that situation to bring up the price to the farmers and ensure that put duties. So we already have import duties on, for example, commodities like crude and refined edible oil. We are having import duties on some of the pulses. At the same time, when we see that there is inflationary pressure, the government opens up and allow imports. Similarly, it happens with the export also. And for example, you have seen that Philippines, they banned the imports of rice because the farmer were not getting sufficient price for their own produce. In that situation, now the window is open only for a month in January, where you can have a specific quota of rice which can be exported to Philippines from any part of the world. And while the country like India is having huge amount of rice which it want to export. Similarly, we have seen that the government also look for putting buffers in place. Now, buffers are a mechanism where the government would take position, store, purchase, and keep for rainy days. And this is common in developing world where actually the government intervenes and creates their own buffers. And the buffers also sucks out a lot of commodity liquidity from the market. So more the government buy, the more chances are that the commodity liquidity in the market would be low. And we see that happening in especially those type of crop where the size of the crop is not as large. It might not impact too much wheat and rice, but it will definitely, or maize for that matter, but it will definitely impact uh, pulses or oilseed. Now, coming to the fourth pillar, where I would like to put in the 2026 market frame is the demand is value segmented. Now, we have been always talking about that consumer will eat irrespective. Yes, I agree. Consumer wants staples, proteins, edible oil. They're all essential, and the demand is not going to vanish. But when there is a possibility that they can trade between different commodities, that we have seen happening, and that we have seen happening regularly, whether it is for food or feed. So, for example, we have seen substitution of soya meal by DDGS. We have seen substitution of chickpeas by yellow peas. We have seen n number of times where farmers, where the consumers move towards a crop which is substantially cheaper but gives the same level of nutrients. And I think modern day consumer is very smart. They understand, they read between the lines. Similarly, we also see that demand diminishing in processing or manufacturing sector. So those who are making savories, those who are making the food-based products or beverages, they would always like to go for economic benefits. And this is where when they see yellow pea flour is cheaper than desi chickpea flour, they would take a switch. And to bring back, even if the price of the specific commodities reduces, go back to the old narrative does not give that level of value because the higher price commodity will always remain higher price commodity. You might see the economic value diminishing if the price of highly priced commodity comes down. But at the same time, it does not, once the change has happened, give sufficient incentive for someone to move back to the previous commodity. And this is what we have seen already in example of pigeon pea and desi chickpea in India, where once the demand moved toward yellow pea, to bring it back to yellow desi chickpea or pigeon pea was a challenge. Similarly, we have also seen that when people move from soya or sunflower oil to palm, which was a war horse. Now, even though the palm price increase, if it doesn't go beyond a specific level, the people to change or switch back to soya or sunflower is not that easy. So this is where also we see that the demand does not vanish, but surely it shifts. So these are the four pillars of 2026: climate risk, trade corridors, policy by different governments, and demand substitution or value segmented demand generation. Now let's go to specific commodities. Now, as I said that on 5th of January 2026, from 2:30 p.m. India time on 9 a.m. GMT, we would be having our first commodity week session on maize. But before we get into session, that's why I'm not covering the supply and demand today. We'll be covering supply and demand at length in all of these sessions. But what is a broad area when we talk about maize? So we all know that maize is the most produced and most volatile grain because it sits at the intersection of food, feed, and fuel, and also industry. We know that actually maize is extensively being used for making starch as well. Now, in 2026, I see that maize direction will depend on three levers. Now, what are those levers? One is the US and South America crop performance. Now, we have seen that of late that South America is producing at the yields which are improving substantially. Yes, definitely. When we talk about America, there is a GMO crop which all generally give better yield than non-GMO crop. So we are already seeing that there is a huge amount of improvement over past couple of decades in productivity when it comes to South America. Has the demand picked up to that same pace? Yes, demand has picked up to the same pace because we have started now moving a lot of grain, that is maize, to biofuel, that is ethanol. And that is very important, and which is also the third pillar of when we say the direction the maize would be going in 2026 and beyond. If the margins of ethanol are good, you will find that more producer would be interested in growing maize and then produce ethanol. So even in Brazil, which was predominantly the ethanol market was dominated by sugarcane, have started making maize-based ethanol. And in India, where we had the initial mandate of E20, that is 20% blending of ethanol in the fuel or petrol, there also the initial idea was that to have sugarcane take substantial share of overall ethanol production as a feedstock. But unfortunately, we have seen that we have moved to maize as a substantial share of feedstock when it comes to ethyl production. So as I said, like, the second lever, which is because of crop performance, is biofuel pull. More the pull. In fact, there are already noise talking about flexi fuel increasing from E20 to E30 in India. And even in Brazil, we are seeing that there has been a consistent push to move towards biofuels. When it comes to soybean, we have seen that also happening in US, where actually the biofuel mandates have been pushed very aggressively. Another area or the lever for maize direction in 2026 and beyond would be feed demand cycles. Now we all know that actually, like poultry, dairy, and aquaculture, they all need feed, and this is where actually generally the maize was used as a grain. But because now you start producing far more ethanol from grain, that is maize, you start getting DDGS. Now DDGS is also protein-rich compound and has been slowly being pushing or displacing because of its cheaper price, the soya meal. And this is where I would say that eventually the pull from the feed side also is going to be very important. And we have already seen that actually the poultry, aqua, and dairy industry all are growing substantially in the large markets like India, or for that matter, Indonesia, or for that matter, Middle East. Now, more poultry, more aqua, more dairy means more consumption of feed. And this is where, again, the direction the maize would be heading when it comes to its, I would say, the market price would depend on the feed demand as well. So as I said, three levers for maize, the North and South America crop performance, uh, feed demand, and the biofuel. So maize price don't just follow farms, they follow factories. So ethanol and starch or even animal feed. These are the factories which actually eventually decides the fate of maize. We will be having extensive discussion of nearly 2.5 hours on 5th of January on maize with different type of players from different geographies. So please don't miss joining us live on our session as a part of Commodity Week on 5th January on maize. Now let's go to wheat, a very important crop when it comes to India. So the theme is simple: geopolitics, food security, and price resilience. Now, the price resilience is easier said than done. While when we create artificial barriers, which is case in India, with neither import nor export, then you can see that you can have a higher price than actually irrespective of the higher crop or the global headwinds or tailwinds. But overall, when we talk about the global scenario, the wheat story is all about export concentration, weather fragility, and as I said, India. India is like a 12th man, right? It doesn't play, but it impacts a lot. The 12th man is a person who doesn't play in cricket. It's an example, or a substitute in football, I would say that. But in football, at least, substitute can come on. In case of 12th man in cricket, he doesn't come on field ever. He only serves drink on messages from the pavilion to the player. So this is what Indian role is. We don't import, we don't export. But whenever India take a policy decision to open up export or ban export, open up import or ban import, the whole world moves just in anticipation. Why? For a very simple reason is that the consumption of India is huge. We are talking about close to 100 million metric tons consumption, right? That's a huge number. And this is where actually, even if India take a position of opening up export, for example, there is a possibility that India would be having exportable surplus of between 5 to 10 million metric ton this year. Now that's pretty decent amount, and it can definitely discount any market, irrespective of the location. At the same time, the quality of Indian wheat, while it is not very high in protein, but for Indian diaspora, that is to make flour, is most appropriate. So again, India plays a very important role, and there is a possibility that Indian government this year, because of surpluses, might look for export, whether in form of wheat product or maybe eventually wheat itself. As I said, with the fragility, I've already explained that there is a problem of heat stress when it comes to northern hemisphere. In India, also we have seen the challenge because last year we had uh, heat stress, but fortunately it has not impacted our crop as it was anticipated to that level. I would say there also being a very recent phenomenon, it is very difficult to ascertain the overall impact of heat stress because it depends on exactly at which time it has come. So whether it is at the stage of milking, whether it is stage of growth, so or just pre-harvest. So depending on that, actually, the yields do change, and it's just not about yield in metric tons, but also the protein content of the wheat itself. So we are seeing the deterioration of quality as well as quantity if there is a heat stress. So weather is going to be playing very important role. So if we have a good weather, India is already in the wheat season. The Rabi season is when we grow our wheat, and India generally have a large crop of 100 million plus. And this is where it's a wait and watch. While the sowing has been a little bit higher, acreage is better. So far, the crop condition looks good. But as I said, now this is a very important stage we are getting into it. And in case there is a heat stress, it can impact negatively the crop yields. And same is the scenario when it comes to the northern hemisphere, or when we talk about Europe, whether it is Russia, whether it is Ukraine. Russia, by the way, actually has been talking about anticipating a bumper yield, also historically highest yield ever. Again, we'll be talking about those supply and demand numbers when we'll be meeting on 6th of January as part of Commodity Week session. And coming to the third part, that is export concentration. Now, you'll find that wheat consumption happens all across the world, and hence you find that close to 160 odd countries do import wheat. And that makes it heavily dependent on the global trade. Russia doesn't consume all the wheat it grows, but actually it exports to a lot of countries, whether it is Middle East, whether it is Africa, whether it is Southeast Asia. Some of the pockets include, for example, Pakistan, right? We might see import there, a huge amount of imports there. We might see substantial import in Bangladesh. We might see substantial imports in Middle East. So we are already seeing that, the imports being there. Turkey or Mediterranean area, whether we talk about Egypt, Jordan, these are also some of the important destination for global wheat. Now, when we talk about 2026, as I said, I don't see too much of movement because there is a sufficient availability of the wheat and it's likely to become range bound. But it could have sharp spikes, and those sharp spikes can be because of, I would say, three key areas. One is the Black Sea export base. Now, Black Sea, we have already seen that challenges with the logistic, port flows, and disruption signal is there. Now, if the condition goes from, I would say, bad to worse, then we might see a challenge there and we might see spikes. And unfortunately, those spikes are pretty sharp. And unlike supply and demand led spikes or dips, the logistic or flow related spikes actually are pretty sharp. So this is where I would say that while I look at it range bound, there could be some sharp spikes. Then the northern hemisphere weather. So again, this is very important that actually if the acreage and yields as well as protein content is not, I would say, comfortable, we might again see sharp spikes because this is where actually you see that a lot of globally available tradable wheat is there. Unlike as I talked about India, where actually it's not having too much of tradable wheat. Similarly with China, which is producing a lot, but it is not having tradable wheat. So tradable wheat, generally you'll find that most of it is in Australia, in the Black Sea area, and even in I would say some parts of Western Europe. And that's limits the overall movement. So any disruption there because of the weather patterns leading to lower yield could also create some spikes. And then the importer behavior, right? We have already seen that most of the buyers today are just in time. So, not too much of holding is there. Majority of the countries, they are not keeping large buffers. And this is where you find that actually, in case something goes wrong, there would always be a panic. And panic buying leads to, we all know that, sharp spikes. So based on these three, I believe, while wheat in 26 will be calm until it's suddenly not. Right. So with that, we move from wheat to another important commodity, that is rice. So again, we'll be having a session on rice as a part of Commodity Week on 7th of January 2026, 2:30 p.m. India time and 9 a.m. GMT. Now, when it comes to rice, rice has been a very interesting commodity of late. It is driven by trade barriers and abundance, which is impacting the global rice bowl. So it is policy led more than the production led. So across the globe, we are seeing pretty decent production, whether it is about Indonesia, which is after a long time has become self-sufficient in rice. Philippines, they have typically literally banned imports of rice because they believe they are having sufficient availability in the form of rice, leading to fall in the prices of their own farmer based on dumping or the imports. They have given a small window of which they believe that is only deficit, which they would buy in January. Similarly, you'll find that first time many countries in Africa are also becoming self-sufficient. So we have seen Tanzania, we have seen of late Kenya, that these countries they have stopped focus on importing rice. And that has led to challenges for country like India, country like Thailand, and country like Vietnam, which are predominantly dependent on export of rice a lot. And that's why we have seen that suddenly the prices of rice are at their historical low. And when we talk about what are the, I would say, key signals when it comes to rice, I believe the rice is gonna be, I would say, pretty bearish going forward also, and we are not gonna see too much upside in rice. One of the reasons is that India itself is sitting on close to 200 billion metric tons of rice post harvest, and the signals are not positive when it comes to imports. Right, we are seeing that already. Africa or Asia is importing South East Asia is importing far less than it used to import. Secondly, we are also seeing a challenge because of the currency competitiveness. So when we see that country like India and Thailand both have their currencies which are becoming weak. So the overall, I would say the deltas, right, has diminished much. So unlike in past when actually you would find that the currency competitiveness lead to the commodity competitiveness when it comes to price, that is also evaporating slowly. So Vietnam and India are price same or similar. Currently, you find that Thailand they are having a little bit higher price because of various reasons related to currency. But eventually, again, they'll have to come on the same, I would say, base in case they want to export. In fact, a lot of discussion, a lot of meetings at the highest level happening in Thailand, where they are trying to control, right, the losses which the farmer might end up having by themselves buying. So government itself is trying to take position and exposure and buy to, like, I would say that stabilize the domestic prices. Asia demand pulse, as I said, like, we are seeing that procurement buffers and substitution towards cheaper grade is already happening. So the rise, the biggest weather event is often a government circular, right, of banning or I would say that opening up exports. So those type of actions, I believe, like, are the biggest event. I don't see, like, any weather event impacting, while people are talking about El Nino and all that could impact it. But when it comes to rice price, I am not seeing too much of impact of weather, at least on rice, and it is more of policy which will be important. Now let's move to the from grains basket to veg oils. While we'll not be talking about extensively all the veg oils in Commodity Week, which we'll be having a session on 8th of January, because we have tried to focus on one very single commodity, which is soya bean. So we'll be talking most of it around soybean, but yes, all the connecting dots of other commodities also in the veg oil basket, which impact soybean. So today, while we'll, as I said, like, I wanted to give a comprehensive overview of agriculture commodity. We'll talk about palm, we'll talk about sunflower, and we'll talk about soya as well. So if you see that palm, it is tug of war between yield recovery versus structural cost floors. So we are seeing that actually, like, yield recovery is slowly going down because of various reasons. It's high cost of labor, replanting cycles, and then the compliance towards sustainability. Similarly, at the same time, while the yield recovery is very important, uh, we are already seeing that the palm oil, which started moving up in price uh, and being the most traded oil in the world, the challenge was that its consumption was also high, but at the same time, the spread between palm and other oil, right, it started diminishing. And that's create a question. So when we say production trends, so oil plantation might constrain future yields, export dynamics, taxes, levies that change trade flows. And we have already seen that actually, like, whether it is Malaysia, whether it is Indonesia as a large exporters and India as a large import, they are always, like, try to counter each other. If one comes out with a specific type of reduction or increase in tariff, other would also try to react to it to ensure that, like, they don't are on the wrong side of the stick. So we are seeing that the export dynamics also leads to, like, possibility of reduced demand and switch to other oils. And for example, this year we have seen that because the palm was on higher price, higher pedestal, suddenly, like, a lot of soya oil was imported in India. Discount equation is what I was talking about. Like, if the palm demand strength, when it remains regains its discount to soy and sunflower. While I always believe palm is a very good oil for sure, it's like, unfortunately seen as a cheap oil with a negative connotation. But at the same time, it is very important for all of us to understand that when it is about trading, people have seen palm at very low prices. Now, for irrespective of whether it's a good oil or a bad oil, whether it is as good or as bad or even better than soya or sunflower, that doesn't goes in the mind of the trade community and even the end user. End user also see palm as a cheap oil. So until unless that perception changes, and I would believe that industry would be taking step to change that perception, but until unless that perception goes, people would always look at palm at a discounted price. If that doesn't happen, people would switch to other oils. So palm doesn't need a shortage to rally. Sometimes it just needs a smaller discount. So this is where I would say that the discount plays a very important role when it comes to palm. We might not see, like, too much of discount this year. So I would surely believe that actually, like, the palm would not show too much of bearish trend, but at the same time, we'll also see maybe a part of demand moving to other oils because of smaller discounts. Now coming to the second veg oil, sunflower. So sunflower remains, and again, that's the beauty of sunflower is that actually because it is regionally concentrated, it is very sensitive to geopolitics, right? So typically, South America and Black Sea are those who export the most amount of sunflower seeds or oil. And this is why actually, these areas, because of the geopolitics there, the market always carries a risk premium, right? And this risk premium, as I've explained earlier, is because of the corridors and the logistic uncertainty. Secondly, sunflower prices always, or seed prices always depend on the crusher's appetite. It is a reverse calculation. It is not that actually what farmer wants or asks for. It is other way around. Based on all the calculation, the crusher decides that what is affordability for him to crush sunflower, and hence the price goes other way around. So typically, the crush margin decides the procurement. So this is also very important for us to understand that whether it is Argentina, whether it is Brazil, whether it is Ukraine, Russia, all these places, there is a challenge of risk premium. And this keeps the prices of sunflowers always a little bit beyond availability of masses. And that's why you find that actually it plays a very, I would say that it is not a very, very significant part of the overall basket when it comes to large edible oil importers like India. We always rely more on palm and soya, and then eventually going to sunflower. Competition from other oils, as I said, sunflower being a premium oil because of not that actually intrinsic it is very good oil, but because there is always a risk premium associated with that, it needs to be able to give a value story. So if the spread is too much, people are not going to be buying sunflower oil. So that's make sunflower oil very interesting commodity because it depends on far more factors than just the production. And then it comes to the disruption premium. The sunflower is also having a bad habit of it reacts to the news in the most, I would say that fastest way. And any bad news, you'll find the sunflower would react to it fast, right? And you start seeing the spikes, and that leads to a lot of price uncertainty when it comes to sunflower oil. Uh, in 2026, I believe like sunflower oil, because of some proactive measures taken by some of the countries which produce sunflower, especially countries like Indonesia, which allowed a good window export, which give incentives. We are suddenly seeing that actually, sunflower this year, we might see that increase in overall demand of sunflower. And at the same time, it will also heavily depend on how the palm reacts and how the palm moves. And if the deltas or the spreads are not too much, we might see a upside in sunflower, at least when it comes to consumption. Now let's go to the commodity which we will be talking at length on 8th of January, that is soybean. Soybean is a very interesting commodity for various reasons, actually. One is actually just like maize, it also is, I would say, feed, food, and fuel. We are already seeing that the mandates, right, for biodiesel, where actually, whether it is US, whether it is Brazil and Indonesia, these countries are posturing for higher blending when it comes to biodiesel. And at the same time, we are also talking about soya meal being very central to the usage as animal feed because it's pretty protein rich. And so 2026, I would see soybean as a protein and energy story. And also the story becomes interesting because there is a lot of debate between about GM and non-GM. Because some of the countries which are not some, many of the countries which are non-GM countries which don't produce GM soybean or allow the import of GM based uh, seeds or the products, they have historically have been having a pretty low yields. Let's take example of India, we are close to 800 kgs per hectare type of yield, while our countries which are producing GM soybean in Latin America, in North America, they are 3 to 4 times of our productivity. And that puts a lot of constraint on the allied industry like poultry, aqua industry in such countries which are not allowing GM-based seeds or GM-based product. While most of these countries, they allow GM-based soybean oil, they don't allow meal and they don't allow seed because they believe all the negativity of the GM induced problems are in protein, they are not in oil. Now, again, three levers of how the soya will act: biofuel policy signals, So how much oil can be absorbed? Because as I said, until unless oil is taken care of, the complex equation of cost of soybean, uh, the parity is not there. Excuse me, I'll just take a water. Okay. So now, as I said, biofuel, more biofuel consumption leads to lower possibility or lower cost of soya meal, which makes soya meal attractive and hence better consumption. So I would say that biofuel policy would be very important, but at the same time, that biofuel policy can become negative for other commodities, including, for example, palm. If more of palm is consumed in biofuels, you'll suddenly find a situation where the overall edible oil or veg oil basket starts to getting heated up. And the South American crop size, and we have seen that actually, there is a improvement in yields when it comes to last couple of seasons in both South America, even in North America. We have seen decent increase in overall production. And the elephant in the room, US-China equation, and why it is becoming more important, because one, that China is actually is having best of the both world. It can import from northern hemisphere, that is USA, and at the same time it can also import from southern hemisphere, that is from Brazil and to certain extent Argentina. But at the same time, China has allowed the cultivation of GM based soybean, and they are also looking to increase their yields. So they are at roughly 20 million metric tons production, and they are looking to double it in next 7 to 8 years. And that might put some pressure, but overall, as there is 120 million metric tons of overall consumption of soybean in China, you might see that actually it will have a small impact when it comes overall to the imports which China would be doing it. But as China was the largest importer of US soybean for a really long time, this year it has hardly imported anything. So that geopolitics is playing up, and that will also decide how the overall soybean prices move in the market. So in soybean, the question isn't only how much crop, it is how much policy pull. So biodiesel or overall incentive being given to usage of oil, edible oil in as a biofuel, uh, incentive given for consumption of soya feed, right? When it is compared to other available meals for animal and cattle as well as poultry. And last but not the least, the geopolitics of US and China. They are going to be playing a very important role when it comes to soybean. Now, from veg oil basket, let's move to pulses. So pulses actually, while we'll be focusing on chickpeas on 9 January 2026 during our session on chickpeas as a part of Commodity Week, let me give you a little bit of overall viewpoint which I'm having for pulses for 2026. Pulses are predominantly driven by a triangle, that is climate volatility, policy signals, and substitution across proteins. Now, when we say climate volatility, pulses while are considered to be rugged crops, but actually we have seen their yields decrease substantially in case there is a weather challenge. And farmers are also very smart when they see that there is a weather which is not, uh, I would say, positive for a specific type of commodity. They also don't grow that. So we see that generally, bad weather comes with a bad acreage as well. So being sensitive to specifically the rainfall distribution, right? And when we see that Pigeon P, the productivity in Karnataka and Maharashtra because of excess rain towards the end of Kharif season this year has led to reduction in yield substantially. So similarly, you'll find that actually 2 years back there was similar problem in Tanzania where actually the Pigeon P yields went down substantially because of excess rainfall. Similarly, the late season heat stress, which leads to infestation of fungal infestation in these crops, and the borus infestation in these crops is also one of the challenge. So pulses overall, I would say that weather is very important, and we have seen that of late, suddenly there is a substantial increase in acreage when it comes to Canada, when it comes to Australia, because of India, one of the largest importers, which typically imports nearly uh, 1/3 of global pulses global trade, and that once it's open its window, and we are having pretty low duty or no duty regime currently in pulses. So based on this large market, we have suddenly seen that these countries where the acreage has increased substantially. But I'm not very, I would say, positive about in case towards the second half of the year we see El Nino, then there could be a challenge. Uh, but that challenge is not going to be for this year. It will, because generally you'll find that pulses, some of the pulses, in fact, Pigeon pea and all that, they're pretty long crop. So you see the impact only after 6 months. But coming to chickpeas, I believe there is abundance. Similarly, when it comes to lentils, there is abundance. When it comes to yellow peas, the markets are flooded, right? So the policy tweak is another very important lever when it comes to the price of pulses. We have seen that any duty change in India, right, or signal of quota, for example, when government decided to buy close to 600,000 metric tons of pigeon pea, the price of pigeon pea, which was going down like anything, stabilized. Still, government have a pretty decent buffer of pigeon pea. Uh, Chickpeas, hardly any buffer with the government. Already 10% duty, and because the prices are low, already discussions are going on to put another 20%, addition of another 20% duty on chickpeas and lentils. So these type of policy tweak, whether anticipated or whether when it happens, right, would be having a huge impact on the prices of pulses. Substitution push pull. So this is where I have seen that I was talking to you about like yellow peas getting substituted with desi chickpea, because that time when India allowed import of yellow peas, desi chickpea prices were nearly 2.7 times of yellow peas, and that leads to substitution. And now that substitution to go back to desi chickpea is not going to happen in just one season. Uh, so it's a interesting lesson of past few years of observing pulses. I would say that when you track pulses, it's not as a one story, right? Track them as a multiple systems, right? So each commodity is a system. We have to understand the substitution pressure, the policy pressures, the origin pressure, the destination pressures, and then supply and demand for sure. So with that, actually, I have come to the last commodity of discussion. So in commodity week on 10th of January, we'll be talking about sugar. Sugar is very interesting because it lives in two worlds. It lives in food and it lives in energy. So I would say the elephant in the room is Brazil's cane and ethanol economics. How much Brazil want to make sugar and how much Brazil want to make ethanol. That's going to be playing a very important role. Another very important lever is the policy, specifically policy in India. How much we'll allow the blending, how much export quotas we will be giving, while we have already allocated 1.5 million metric tons. But you know that actually that is a number we're being given. Uh, Currently, the parity is not good enough to export. Domestic prices are better than the export. But again, this is where the policy plays a very important role. How much blending, and then actually, how much differential bonus is being given to grain for conversion to ethanol on the typically what the OMCs, that is oil marketing company, pays to the distillers of sugarcane or molasses. So that is going to be playing a very important role. So policy in key producing countries, whether it is Brazil, whether it is India, is going to be playing a very important role when it comes to the, I would say, the direction of sugar in 2026, and then the weather risk in major origin. Now that is also very important. Small price surprises create big moves, right? So, for example, last year we have seen that reduction in production leads to a lot of policy enabled decisions, which lead to further changes in the price, and then also not just in India, right? This has been a phenomenon when it comes to Brazil as well, where actually change in the policy or more push towards the blending, suddenly you find the dynamics changes substantially. So sugar remains high beta energy, linkages amplifies every supply surprise. So that's very important. We have to understand that it's a high beta game to play. And with that, actually, the sugar would be our last commodity we'll be talking about in this upcoming commodity week, which is, as I said, would be from 5th of January to 10th of January. We have already had some previous different digital assets which have done pretty well, whether it is agriculture roundtables. We have done 11 of them since 2021. Then since 2021, we are doing Women in Agriculture Web Summit, fireside chats, blockchain master classes, and many more. And these are some of our digital asset newsletters, which again are having a total subscription of close to more than 80,000 people. And I said that we are predominantly digital platform. We are more on LinkedIn, and this is where actually we believe, predominantly the majority of decision makers would like to be on. They are not much on Instagram, they're not much on Facebook, and they might be consuming definitely YouTube for sure. But I believe LinkedIn is what where you see the real decision makers to be, and that is what we target. And as just for your information, HnyB is a boutique consulting firm which works on intersection of technology, innovation, agriculture, and food. And with that, I would like to pause here and thank you, and would request you if you are able to join us next week based on the commodity of your interest, because we believe we are enabling innovation by driving transformation. With that, I would like to thank all of you for your patient hearing, and looking forward to see you with our awesome panelists. In fact, we are, as I said, some of the best from the world participating, uh, close to 42, 43 odd sharp speakers discussing about six commodities is what we bring on the table. And thanks a lot for patient hearing, and looking forward to see you again on 5th of January, 2026. Again, to all the audience, wishing you a very happy 2026. May you have an awesome and a rocking